Live from New York City this morning. Good morning, good morning. Equity futures negative about 0.2% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, the debt limit deadline may come as soon as June. The Federal Reserve's two-day meeting begins in Washington, and Morgan Stanley planning 3,000 more job cuts. We begin with the big issue, one and done.
Likely one and done in May.
One and done?
One and done.
I think one and done is probably the answer here.
If the Fed says one and done, you're going to see financial conditions ease.
I think the Fed has an incentive to talk a bit tougher.
Markets are in wait-and-see mode as to what Jerome Powell does.
They have said that they're very data dependent.
The number one issue for the Fed is not growth, it's not credit conditions, it's not bank failures, it's not earnings, it's inflation.
Clearly, there is a risk that inflation stays higher for longer.
Inflation, that's what matters.
That is true. Inflation is the bête noire of the economy.
They'll do one more.
100% May we'll see another hike.
The Fed's job is not done.
Joining us now to discuss, Bank of America's Megan Swiber alongside Nuveen's Tony Rodriguez. Megan, first to you. Is this Fed truly one and done?
You know, John, we still have time to see whether or not that will indeed materialize. But our house view is that this will be the last rate hike of the cycle. But as was said up in that lead up, the Fed is still going to be in data dependent mode. What's still most important to the Fed is inflation. They're still going to be monitoring the data that comes in. What's very important here is whether or not there's been a shift in bank lending behavior, effectively tightening that the Fed thinks is already in the pipeline and basically will be felt by the economy. These are the things that the Fed will be having a very watchful eye on in the months ahead. House view is this is the last 25 basis point rate hike, but the data is still going to be very important here.
I saw that from Mike Gapon. Enough juice for one more hike. Enough juice for one more hike. Tony Rodriguez seems to be the view of a lot of people on Wall Street right now. I hear a lot about a conditional pause. And Tony, I want to know what it's conditional on and whether the bar for hikes is higher or lower than the bar for cuts of the Fed going forward from here.
Well, good morning, Jonathan. Good to be with you. And we do think the Fed is one and done. We don't think they're going to state that clearly because we do think the bar is still higher for cuts. Right now, the Fed has an inflation problem. As we look forward and we look towards the back half of the year, we do think you'll start to see economic weakness flow into the economy here. Tighter lending conditions, we think, are going to be one of the key drivers. But the evidence of that is still not clear enough to the Fed versus the evidence that inflation is sticky, it's much higher than their target, and their belief is that they need to at least pause at this new higher level, in our minds, for the balance of the year. So that means that the bar for a cut is higher than what the market is currently pricing in.
Bank failures haven't stopped them. The last time they met, a bank had just failed. They hiked interest rates. They meet this time. The two-day meeting begins today. They're about to hike interest rates tomorrow after another bank failed. We've had Silvergate, SVB, Signature Bank, First Republic, throw in Credit Suisse. That makes it 5. And Megan, yet still they've hiked interest rates. Can you think of a parallel, a moment in history that is similar to this one, where a central bank like the Federal Reserve has looked at bank failures and chosen to keep increasing interest rates?
Yeah, John, it's a good conundrum that you bring up here. And I think it really does suggest that the Fed has its credibility at stake here. If they're viewed as hiking into more banking failures, right, this is putting more pressure on the banking sector. But really, enemy number one here is still the inflation picture. And what we've seen from banks and the data that effectively the Fed has, we get this data on a weekly basis every Friday. You can monitor how banks' deposits are evolving, how their lending behavior has been evolving, and things seem to be stabilizing here. That's really the key word, and it's the key word that Powell and Secretary Yellen are very much so keeping a close watch on here too. Stabilization and still this very hot inflation does support the Fed going and delivering another 25 basis point hike. again, the Fed thinks and believes that banking lending behavior is likely going to evolve in the coming months and create this additional tightening pressure on the economy. This is all to be seen. We'll get the senior loan officer survey for April, and will give us some indication of whether or not bank lending standards have tightened further. But still, enemy number one here is inflation. The science from the banking sector that we seem to be broadly getting is stabilization. Both of these two things together encourage just that additional juice left to deliver this.
It's kickstarted a process, that's for sure. Some might say accelerated a process that was already seeing some momentum. Tighter lending standards, tighter financial conditions coming around the corner. This is the question we've got to ask, Tony, off the back of the banking stress of the last month. We've got to work out what kind of economic outcomes do the bank failures lead to, and ultimately how quickly those outcomes will materialise. How long will this take? What are, so to speak, and I've asked this a few times, Tony, the long and variable lags of a banking shock?
Well, Jonathan, there are long and variable lags, as you mentioned. We certainly are seeing that now with the bank balance sheets and the impairment to their asset side of the balance sheet. And that's what really, was a big part of what drove some of these failures. In terms of seeing it flow through the broader economy, we came into this with a very resilient consumer, with a very resilient corporate balance sheet. So in our minds, it is going to take longer to flow through. That's a strength we're seeing in a low unemployment rate. But as we look forward to the end of the year, our view is that you are going to start to see that. Our view is that we'll see a mild recession. It's likely to kick in early in 2024. At the very earliest, we'll start to see signals of that in the fourth quarter. That is what we think will eventually lead the Fed to start to shift to cutting rates early next year. But whereas the market is pricing a September cut, for example, we think that's way too early. And that's because the economy is going to be a little more resilient because of the strong consumer, and inflation is going to be a little bit stickier than what the Fed needs to see in order to be able to pivot.
You mentioned the economy and the labour market. On Friday, it's payrolls. Just to give you a sneak peek of the median estimate in our survey so far, we're looking for something like 180,000 in Friday's jobs number. That's down from 236 in a previous month. Unemployment, expecting that to climb from 3.5% to 3.6%, according to our survey of economists on Wall Street and beyond. That's for Friday. We've got to get through the next 24 hours. The Federal Reserve just around the corner. Mike McKee, a busy week for Fed speak, the Federal Reserve, and for the data too.
Yeah, we can boil it down to maybe raise in May and go away. That's what the Fed would like you to think. So that will color the way they handle this meeting and the statement that comes after. The question is going to merge from the highest rates in 16 years to how long they will stay there. In after the great financial crisis, when they started cutting rates, it wasn't for 15 months after they hit the peak, 7 months after the 2008 or mid-2000s rate scare. So they don't always keep it for a year or so, but they have in the past. So that is the question. And there's no percentage in the Fed telling you that it's going to be cutting rates next. So expect a change in the statement this time to incorporate, much as they have the last two times they got to the peak, the idea that we could see rates rise again. Any additional firming, they said in 2006, some further gradual increases, no promises that they were going to do it, but the idea is left in the minds of the markets so that they don't think they can immediately price in something else. One other question is, and this is a number of people on Wall Street talking about it, do they need to do something about QT? This is the balance sheet here, and it has been rolling off much more slowly than the Fed anticipated. They're not reaching their caps, particularly with mortgages, because who wants to refinance or sell their house right now when mortgages are so much higher? And so the balance sheet is absorbing duration, and that's making the markets less sensitive to interest rates, and that is pushing down on financial conditions. So there's a theory out there that they might have to adjust the pace of their sales.
Mike McKee, thank you, sir. Let's pick up on that. That's a really important point. Megan, what's the story with the balance sheet, just to build on what Mike was discussing?
Yeah, I think the balance sheet is a really important point here, too. In our view, we are not expecting the Fed to tweak anything regarding the balance sheet, specifically at this meeting. We really don't see the Fed changing anything regarding its tapering of asset holdings until we see that first rate cut. We're not expecting that to happen until the first quarter of next year after we see signs of a mild recession in the US. But things that could get the Fed to have to adjust the balance sheet policy before that effectively are concerns about financial market stress. So if we see periods of Treasury market illiquidity where the Fed needs to readjust its holdings, be that buyer of last resort for Treasuries in the market, those more liquidity dynamics are things that could kind of get the Fed to step back into the market sooner. But we are not expecting the Fed to adjust anything regarding its balance sheet at this meeting, and think that at the end it's really going to come down to the economy turning before the Fed recalibrates.
Just looking at Treasuries right now, the 10-year 355. Tony, I've got your 10-year call for the end of this year at 325. You think we've already seen peak inversion? I guess my question to you, Tony, this morning is, what's left to play for here?
Well, John, I think what's left to play for is a little bit of a tailwind from that modest decline that we're expecting. So when you kind of pan out to a really broad asset allocation, right now markets we feel maybe have a little bit too much optimism built into them. Our overall outlook is you want to be modestly underweight equities and overweight to fixed income. So we do think that that little decline in rates that we're expecting is going to provide enough of a tailwind to provide pretty attractive returns from fixed income asset classes. So it's a good hiding spot for investors who are concerned about that slowing economy that we see coming forward and who are concerned about the Fed maybe overdoing it on the tightening side of the equation.
And Megan, on the inversion call, you seem to be on the same page. Are you retaining a long bias in the Treasury market?
Yeah, I think Tony makes a very good point here too. If you look at history as a guide, you usually see 10s rally pretty meaningfully in the 12 months following the Fed delivering this last rate hike of the cycle. If this is indeed what we're seeing, this is the end of the Fed's hiking cycle, now is a good time to be buying duration. I particularly like buying duration in real yields, effectively the inflation-protected product, because I think that really at the end of the day, the story of whether or not the Fed's hiking cycle is over is going to come down to the inflation story. But yes, buying duration last hike makes a lot of sense.
Megan, you're going to stick with us, Tony, as well. We're going to talk about the debt ceiling in about 5 minutes, so don't run away. I know that deep down you really want to run away because no one really wants to talk about the debt ceiling, but they will have to in Washington next week, and I'll get to that in just a moment. Equity futures on the S&P 500 this morning, negative 0.25%, with some movers going into the opening bell. Here's Katie.
Let's kick off with 3 earnings stories. Let's start with Uber, because consumers still spending in a big way on rides and food delivery. Adjusted earnings were $761 million in the first quarter. That was well above the average estimate of $678 million. You can see shares up about 8.4%. Moving on, Pfizer too beat on estimates and on profit and revenue. Of course, it struggled with the drop-off in demand for its COVID shot. It's looking for more growth avenues. Shares treading water here. Let's move on, though, because Chegg, John, this is fascinating. Chegg, it's an education technology company reporting earnings yesterday, and it warned that ChatGPT is threatening the growth of its homework help services. John, this is what disruption looks like.
The kids are cheating on their homework. Apparently. Katie, thank you. Coming up, DC gets a new debt deadline.
The most immediate thing we can do is ensure the continued reliance of our economy and the financial system.
President Biden setting up a meeting with top lawmakers. That conversation with AMH in D.C. up next.
The most immediate thing we can do is ensure the continued reliance of our economy and the financial system. The most important thing we have to do in that regard is to make sure the threat by the Speaker of the House to default on the national debt is off the table.
And what was your second question? Debt limit. The president still hasn't talked to me.
A new debt limit deadline turning up the heat on Congress. Secretary Yellen said in the X state, writing in a letter to congressional leaders, the following: "We will be unable to continue to satisfy all of the government's obligations by early June and potentially as early as June 1. The House did its job. Now it's on Biden. That's the message from Speaker McCarthy, writing the following. There's a bill sitting in the Senate as we speak that would put the risk of default to rest. The clock is ticking. The administration responding with an invitation calling top lawmakers to the table. A GOP aide confirming McCarthy will attend that meeting. For more, let's head down to AMH down in D.C. Anne-Marie, just some movement here in the last couple of days.
Yeah, it's really the opening start of these negotiations, Jonathan, but it is progress. You had Speaker McCarthy get this bill through his House. What that does is it does lift the debt ceiling, but it comes with fiscal spending cuts, and he maintains that he will not pass a clean debt ceiling. He has to make sure that he has spending cuts attached to that. But this is something that the White House says they cannot sign off for. They want a clean debt ceiling bill. But at the end of the day, the ball was in Biden's court after Speaker McCarthy was victorious in getting his caucus together. And now what President Biden is doing is not just inviting the Speaker of the House, who, yes, will be attending that meeting next week, but he's inviting all of congressional leadership. So what many are saying, this is progress. The big issue they have, Jonathan, of course, is the timeline. Even this week alone, we have the House in recess. You have Speaker McCarthy in Israel. And then when they come back, it's a very short timeline until they get to June 1st, with Treasury Secretary Janet Yellen saying potentially that is the first date as soon as the U.S. can exhaust these measures of how we are paying our bills.
Anne-Marie, I have to say that May 9th, which is a week from today, doesn't feel like panic stations, all hands on deck. Does it feel like panic stations to you?
No, it doesn't, because if it was all panic station, hands on deck, you'd have them there tomorrow. But again, Speaker McCarthy's not even in the country right now. He's leading a CODEL till Israel. He spoke at the Knesset yesterday. That's where he got that question. That was before Biden picked up the phone and called him. And he said, I haven't spoken to the president. He continues to say, and he's told me in 2 interviews last month, that he has not spoken to the president since February 1st. And he wants a sit down. He wants that meeting. So May 9th, that puts it out to a week. And then, of course, Jonathan, the president's going to be leaving on 2 key international trips to Japan and to Australia. So it's getting very difficult for Washington to act in time. And that is when people are concerned. And if you look at Greg Vallier's note, he says he's now calling this really a debt crisis. And the issue is, what many say is potentially Washington won't act until Wall Street panics.
AMH, I don't see much sign of panic just yet. Anne-Marie, thank you.
No.
I see signs of repricing, so let's be clear about that. The prospect of the ex-state falling a little bit earlier than anticipated. You look through the T-bill curve across various maturities, and the at-risk security seems to come in just a little bit, and one of those T-bill yields popped just a little bit yesterday. Now, Megan, can you walk me through what you're seeing in the T-bill curve, so to speak, and where the ex-state might fall and what the at-risk securities look like right now?
Sure, Jonathan. So effectively what Yellen is doing here, in our view, is guiding the market, guiding policymakers really towards this band of uncertainty around when Treasury is going to be running out of financing. So this early June number really does make a lot of sense. So some of our projections for when they can ultimately hit that X date run to late July to early August. But we do think that Yellen is giving the market and giving policymakers her view on ultimately what the highest probability looks like in terms of trying to build in some error band around all of these forecasts. These are hard numbers to get right effectively at the end of the day, and Yellen doesn't want to be caught off guard by giving the market and giving policymakers a date that's later than when these measures are effectively exhausted. And you're right. Effectively, the bill market is responding to Yellen's guidance that we saw yesterday. But at the end of the day, the story is going to be, as we look forward to the next few weeks, right? And it seems like, as was mentioned, we haven't really seen signs of outright panic yet. Ultimately, the bond market, the longer-term Treasury bond market, is going to be what we will see respond to this. Probably likely to see more of this risk-off flow, more of a bid for longer-dated Treasury yields, which does seem a bit counterintuitive.
So buy bonds is still the story. Tony, bonds get into trouble, buy bonds. And to be specific, Treasuries get into trouble, buy Treasuries. Tony, that raises a question. Is there any risk outside of the at-risk securities? Is there any risk at all outside of those securities?
Jonathan, we think that there is. So, the debt default hand grenade right now is in the hands of both sides, and they're going to use this for political theater to score some points. But as we get closer to the X date, whether that is early June, even though we think that's a conservative assessment by the Treasury, and we agree that it's in a more of a mid-late July, early August timeframe. As the timeline gets tighter, you're going to see volatility increase, and the risk is that you can see this suddenly begin to really crimp the capital markets. And as that debt financing becomes less available, as volatility rises, that's going to impact, obviously, capital market pricing. And that's when you can start to get into some scenarios where, companies may not be able to refinance. We don't expect that to be the case. We do think that ultimately the brinkmanship will lead to an 11th hour agreement to raise the debt ceiling. But the ability to have an unexpected accident increases the closer we get, and the markets are going to have to price that in.
Megan, the difficulty that I've got is that we're expecting, or rather you're expecting, the Treasury market to behave like it has DM characteristics when it's overseen by institutions which are displaying EM characteristics. Now, I'm wondering, Megan, at what point that story kind of flips and that people start treating treasuries differently. Now, it hasn't happened before. I'm wondering whether you think it's going to happen anytime soon.
Jonathan, it's not my view that happens. It's not really our view as B of A that we will see the Treasury debt credibility really get challenged in a meaningful way here. And the question really comes down to where else is money going to go at the end of the day. Treasuries typically and historically demonstrate this key quality of being the risk-free asset in the world. And as you mentioned, the key thing that will ultimately is getting challenged here is whether or not is the timeline of these payments. But regardless, it's effectively written in the amendments that the U.S. government should not be challenged in terms of its ability to pay its debts. And certainly this does pose questions and a lot of uncertainty around effectively volatility and political grandstanding in the near term. It's ultimately still going to be the story of Treasury still needing to respond as the risk-free asset, because when we do see this pickup in volatility, we do think that's ultimately where money is going.
Our trust in this market is just amazing, and it gives politicians on both sides of the aisle the luxury of acting irresponsibly when they so desire. Megan, thank you. Tony 2, equity futures negative 0.2%. Equities a touch negative. Let's get you some morning calls. First up, Morgan Stanley upgrading Dow to overweight, pointing to an attractive valuation. Roth MKM upgrading Penn Entertainment to buy, seeing a potential beat and raise quarter on Thursday. And finally, Citi downgrading Coinbase to neutral, expecting regulatory headwinds to continue. Coming up, Daryl Cronk of Wells Fargo remaining defensive ahead of a busy week of risk events. That conversation up next. Your opening bell just around the corner. "23 seconds away from the opening bell this morning. Good morning to you all this Tuesday. Slightly softer, negative, down about 0.2% on the S&P. The Nasdaq almost totally unchanged. Yesterday, the S&P 500 not giving you a relief rally at all, even with the solution provided to First Republic, acquired by JP Morgan. There's your opening bell. Switch on the board and get to the bond market. Yields down a couple of basis points on a 10-year, 354. Yesterday, really interesting session. The ISM manufacturing number came out. The prices paid component of it rebounded. That spooked people in the bond market. Yields up. Meta and a bunch of other companies came to the bond market. That knocked the Treasury market around as well. And we were higher by more than 10 basis points right the way through the curve yesterday. Still in at around 350 on a 10-year this morning. In the FX market, look out below euro. Euro-dollar printed new highs for the year intraday last week, very close to 111, has backed away every day since. The euro is negative against the dollar for 4 straight sessions, the longest losing streak going back to late February. It's been a while since we've seen some persistent euro weakness. Outside of that, crude lower by close to 1.7%. We're back down to about $74.30. 45 seconds into the session, we're negative 0.3% on the S&P. On the Nasdaq, we're down by about 0.15. One stock to watch at the open, Uber, reporting a smaller than expected quarterly loss and delivering an upbeat outlook. The CFO said this: "We delivered record profitability and free cash flow in Q1, and we're poised to expand profitability again in Q2. Ed Ludlow joins us now. Ed, these numbers pretty good. The stock with a pop.
Yeah, the stock with a pop up around 6%, biggest jump since November. On an adjusted EBITDA basis, Uber coming in at $761 million in the first quarter, significantly above street expectations and giving us that second quarter forecast of adjusted EBITDA 800 million to 850 million, again, above what the street thought that they would do. There's some really interesting dynamics read through to consumer behavior here. If you look at gross bookings, $31.4 billion for the quarter gone, slightly below estimates of 31.5 billion. It's actually freight that dragged that down, a decline in freight. But if you look at the rider gross bookings, 15 billion above expectations, there's some data, I suppose, that points to the idea that riders actually may be taking more frequent rides. Definitely, this is a consumer base when it comes to ride-hailing and food delivery that is kind of weathering the storm and doing well. I guess a question for Dara Khosrowshahi going forward, Jonathan, is how long does this last? You know, it's a pretty bullish outlook that they've given for the second quarter on an adjusted EBITDA basis. But again, note that freight decline being a slight drag on gross bookings.
Well, that's a question you can ask the man himself. I know you've got an interview coming up in about 3 hours from now. I'm looking forward to it. Dara Khosrowshahi, the CEO of Uber, sitting down with Ed Ludlow and Emily Chang. Ed, what's the focus of that conversation going to be a little bit later for you and the team?
Yeah, for me, I try and get the macro picture. I really do think that this is a consumer that's holding up if you go by gig economy metrics. We don't see that everywhere else, right? You know, we're trying to discern with crystal balls through this earnings season what the outlook for the second half of this year looks like. If you go to the semiconductor sector, they'll tell you we're going to recover. Do they see the sustained demand from their riders, and how are they going to keep that demand going through the latter parts of this year? I'm really interested in freight, Jonathan, because if that dropped off, it declined in the quarter gone. What does that tell us about global logistics and supply chain?
Ed, looking forward to the show. A couple of hours away, Bloomberg Technology. Ed Ludlow sitting down with the Uber CEO alongside Emily Chang, I believe. That's going to take place on Bloomberg TV a few hours from now. About 3 minutes into the session, equities just a little softer, negative 0.4%. Uber a whole lot higher, up by 7%. Let's stick with earnings. MGM Resorts under pressure. Despite delivering a Q1 beat, analysts expecting a slower summer in Vegas to weigh on shares. Katie, that stock down 2%.
Indeed, there's a disconnect here between the numbers and what the market's doing, because this was a big quarter for MGM. Of course, this quarter might not repeat itself when you think about what could happen this summer, but apparently everyone is going to Vegas, at least for now, at least in the first quarter. Revenue in that market, which of course is MGM's largest, it soared 31% to $2.2 billion. Adjusted earnings jumped by more than 40%. And Macau, too, it posted a big rebound, John. That business more than doubling. And in both of these markets, of course, this is in some ways a pandemic story, especially in Macau. A lot of that rebound, of course, coming after the country lifted those COVID-19 restrictions. All told, MGM earnings overall, they came in at 44 cents per share. The average analyst estimate, just for context here, was just 10 cents. So a big beat. But as you can see, traders apparently not too impressed. MGM down 2.5%. Caesars, too, is under pressure. That company reports after the bell.
Not a shocker, just a little lower. We're down about 3% on MGM, as Katie indicated. That's the story for them. Let's talk about Big Pharma. Pfizer out with better than expected results, doubling down on its forward guidance. The CFO had this to say: our strong balance sheet will continue to provide the flexibility for future dividend increases and share repurchase activity. Kelly lines that stock up by a little more than 1%.
Yeah, even though the guidance is unchanged, John, but that move, the 1% move higher here at the opening bell, was driven by really sizable beats on the top and bottom line. Earnings per share coming in at $1.23. The street was looking for 97 cents, and primarily that was driven by stronger than expected demand for its COVID-19 products, both its antiviral Paxlovid as well as its vaccine, performing better than expected. And one analyst over at Wells Fargo saying in large part that's due to the demand driven from China, as well as a government contract mostly being delivered in the first quarter. However, I would note that when you look at that shot revenue, for example, came in at $3.1 billion, still represents a 77% decline from the first quarter of last year. So a smaller drop than expected, but still objectively a pretty large drop. And our analysts here at Bloomberg Intelligence are saying today that these results are, quote, nothing to get excited by, noting that ex-COVID sales actually missed expectations by about 1% and are very own Sam Fazeli saying the fact that the guidance is unchanged shows how hard it is to forecast COVID-19 revenue in 2023. And I would note that 2023, as a result, has been pretty tough for the stock. Even though it's up 1% today, it still remains lower by more than 20% this year, John.
Kelly, thank you. Thank you very much. That stock is up by about 1% right now in early trading. 6 minutes into the session, we are negative 0.4% on the S&P 500. Doing a little bit better, relatively speaking, on the NASDAQ. We're down by, let's call it 0.16% on the NASDAQ composite. For the broad bond market, yesterday yields much higher. This morning yields essentially unchanged at the front end. The 2-year, let's call it 4.13-ish. On a 10-year, 3.55. Yields come in a couple of basis points. The view on the Fed. The meeting starts today, concludes tomorrow. And here's what you're going to hear a lot of over the next 12 hours or so. One and done. That is the consensus on the street. Darryl Cronk of Wells Fargo also calling for another 25 basis points, telling investors to stay defensive ahead of a busy week. Writing this, the risk-reward dynamic is not currently attractive. Darryl joins us right now. Darryl, wonderful to have you on the show, with us, buddy, as always. Darryl, I wanted to start with this quote, and it came from my team here at Bloomberg Intelligence. According to the data, as of last week, nearly 81% of S&P 500 companies have beaten analyst estimates, the biggest proportion since the third quarter of 21, and yet this. The median stock has outperformed the index by just 0.1% on the day of results. Darryl, why aren't these stocks being rewarded for decent earnings?
Yeah, I think that's exactly right. I think it's because people are still, John, worried about what the future holds. I mean, if you look at the earnings estimates from today, we're tracking about $51 to the quarter for Q1. Fourth quarter still has all-time record highs for earnings. It's hard to paint that path of consensus estimates on where we're going. So what's interesting to me is both the earnings still have to come down, which is not a new story, right? But companies are not getting rewarded for any kind of beat that they have. Margin pressure is there. And what was quiet about April was everybody talked about what a great month April was for the index and everything else, and we know the narrow leadership in that story. But the two best performing sectors in the month of April were healthcare and staples, both defensives, right? So you're seeing defensive start to take over. The leadership and the earnings estimates just don't sync right now, and that's why we think the risk-reward dynamic here, we're half a point, half of 1%, I guess is the way to say it, off of the 6-month high for the S&P. It's just not worth it in today's world.
Darryl, what would be worth it? What would drag people out of the cash they've piled into over the last 12 months? I'm looking at money market funds just exploding. There's so much money that's gone into them over the last year, Darryl. What would pull them back out?
I think you've got to see the natural order of the cycle play out. So, I mean, everybody knows this, but think about it logically. You know, you have an inflation shock, followed by a rate shock, followed by a bear market, which is where we are right now, followed by a recession, which is where we think we're going, followed by rate cuts, and then followed by the next bull market. So you've got to get to that rate cuts and bull market. You know, history tells you, if you look at this, John, the bottom in the equity market in the S&P 500 doesn't come until after the first rate cut historically, and it's typically about 5 to 6 months after the first rate cut. So you tell me, we don't think the first rate cut happens in 23. We think it probably happens in 24. But even if you take the most aggressive estimate of 23 and then spin forward 5 or 6 months, you've still got a while here where we need to kind of reset valuations and multiples where the risk reward becomes attractive. The equity risk premium is still 125, 30 basis points. You need that number to be 250, 300 to really bring cash back in at an attractive valuation.
And let's get into it a little bit more. The missing piece of this, and I think you alluded to it there, Darryl, the missing piece of this, we've had the rate shock. We haven't had the credit reality check. Are there reasons to believe that we will?
That's right. Well, again, if you use the idea of a natural order of things, what typically happens in these cycles is you have a liquidity shock, which you could argue is happening in March and April with the stress in the banking crisis and the failures, followed by a profitability challenge, which we think we're in right now, right, where margins are getting squeezed, profits are getting challenged. And then what typically comes with varying time lags is a credit shock. So we think that lies before us. You can debate the materiality, you can debate how much, how deep. But I would note, John, and this is really important, what people are missing about what the bond market is telling you today is that the length of the inversion of the bond market of every major yield curve. It isn't the basis points, it's the length. Now, we've had the 3-month to 10-year inverted 6 months. and the 2-year to 10-year inverted 12 months. Those are both very consistent time frames with when recession sets in after the initial inversions.
Do you think, Darryl, this conversation we're having goes some way, in fact maybe all the way to explaining why the regional banks are struggling to get off the mat and rally? Yesterday, even with the First Republic solution, KRE down 2.8%. This morning, down another 1%. The Russell underperforming. There's a big tilt there towards the financials. The Russell down by 1%. Darryl, does it explain why the regionals have struggled to rally even with solution after solution being offered over the last month or so?
Yeah, I think there was a lot of people out yesterday saying, look, the JP Morgan First Republic deal or solution, if you want to call it that, is the end of this crisis. If that were the case, we should be seeing a bigger rally yesterday and today out of financials, and they're nothing, right? There's just no activity there. So I think the combination of people worried about some of the small, medium-sized business models, what is coming in more regulation in that space, which actually, depresses earnings or leans on margins, and the idea that net interest margins eventually get squeezed, I think probably has that area. If I'm looking at attractiveness today, John, if I can get a 3-4% dividend on financials at 1x tangible book or 8-9 times earnings, or I can get a 3-4% dividend on energy at the same multiple, I'm picking energy every time.
The energy story is interesting to me, Darryl, and has been for a long time. Primarily because a lot of people offer me quite a bearish scenario on the economy and financial markets, yet still they come out with a long on energy at the end of the conversation, Darryl, and I often ask the same question. Why can that be? How can that be? How can you have this negative view on what might happen in the US economy and in financial markets, yet still like energy?
Yeah, I think that is the question to ask, and it's the smart question to ask, John. I mean, the reality here is you have to weigh what's going to play harder and more. Cyclicality, which is what you're alluding to, or the long-term supply-demand dynamics. One is a short-term story, one is an intermediate and long-term story. I do think, and that's why you're seeing, WTI oil prices back down about on top of where they were on last month's OPEC Plus cuts. So we've brought oil prices down nicely to reflect that cyclicality, to reflect what's probably a deteriorating economy in the back half of the year. That said, if the economy is heading into the recession, which we still think is our base case, you should have oil more like $30, $40 a barrel, and it's simply not. And the reason it's not is because the world is short long-term energy sources, and oil being one of them, fossil fuels being one of them.
Yep, heard that argument a few times. Darryl, thanks for being with us, sir, to give us some clarity on how you're thinking about the market right now. I appreciate it, always do. Thank you, Darryl. Darryl Cronk there on the latest from Wales. KRE, the regional banking ETF, is down by close to 2% right now. TCW President Katie Koch, formerly of Goldman Asset Management, you might remember her from coming on this program over the last few years. She had this to say on the regionals over at Milken to the team over in California at the moment. Regional banks is an area we're concerned about because of deposit flight, and also they have the highest exposure to commercial real estate. We heard something similar from Charlie Munger of Berkshire Hathaway to the FT over the weekend as well. There seems to be a reluctance to dip a toe into these names, and there's got to be a reason for that. Even after the solution for First Republic, you are not seeing a rally. Coming up on this program, another bank, another round of job cuts.
Like every institution, you make some adjustments around the capacity, but we're playing the long game in investment banking.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Apple co-founder Steve Wozniak. That conversation at 12:30 p.m. Eastern, 5:30 p.m. in London. This is Bloomberg.
We have a lot of talent that wants to come and join us, and we've been bringing some terrific talent in the healthcare sector, in the technology sector, and investing in that. Like every institution, you make some adjustments around the capacity, but we're playing the long game in investment banking.
Another round of job cuts hitting Wall Street, this time from Morgan Stanley. Bloomberg reporting plans to slash as many as 3,000 positions, or 5% of its staff, making it the bank's second round of layoffs in just 6 months. Bloomberg's Sonali Basak joins us now from Milken in LA. Sonali, wonderful to catch up with you. We know that this side of the bank has been difficult, and now we're starting to put some numbers on it slowly.
Yeah, absolutely. We had a fear that we would get to this point again, given the environment, John, has been weak for many, many months. But here's the thing. It's that the end in sight is not quite close. When we talk to a lot of bankers, they are starting to push the horizon out even into 2024 potentially for deal making to come back. Now, there are signs of life in the capital markets, debt issuance ticking back up after a very long slump here. But again, it's not enough to keep staff on board in mass. So we've seen thousands of job cuts here being planned at Morgan Stanley, 10% of the workforce or more over at Lazard. And then you also have Bank of America fairly recently, just months ago, saying that they would cut hundreds as well. Remember, they have been cutting kind of hundreds here and there as needed. Now, again, 2024 is no promise. And not all is bad. Over on the buy side, for example, we still have hiring here at the private credit firms. But remember, some of these firms like Apollo are coming off of hiring near the top of their range at the end of last year. Still hiring this year, just maybe not at the paces they're seeing before. Now, remember, if you couple that with what you're seeing, for example, at Credit Suisse, where again, UBS, Credit Suisse, you have even more job cuts underway with the integration. And then if we see more bank consolidation as well, that could also mean more synergies. You have a lot of capacity in the market here, supply coming up of talent, and none clear about where all of that talent goes, especially because you don't have competition from other industries the same way you did prior to when we saw the rate tightening cycle here. So again, not clear how much more pain there is to come, but certainly this is the start of another wave.
Shonali, we've all been following the conversations that you, together with Romain and the team, have been having over at the Milken conference. Can you just give us the tone of things around regional banks right now? I saw those comments from Katie Koch just yesterday. Not really encouraging, were they?
No, she definitely came down harder than many, many others, but there are a few tones that a lot of people have hit here. That commercial real estate worry, Mark Rowan over at Apollo even saying he sees a second wave coming. The office vacancies numbers being a lot worse than many people realize. That is one part of the larger commercial real estate sector, but one manager told me it is a small part of their portfolio, but like most of their problems. And so certainly until that shakes out, it's unclear how deep the pain can get. And from the perspective of the folks here at Milken, the market has not repriced to reflect that reality. So again, a lot of things on the sidelines here to be watching out for in terms of more pain some of these money managers can feel before they start feeling a little better and being able to enjoy the other parts of portfolio that they're starting to dip into here as some valuations start to become more depressed.
Brilliant work. Just looking forward to the coverage through today as well. Shonali, thank you to you and the whole of the team on the West Coast at the moment covering these issues. Want to get back to the job cuts, not just Morgan Stanley, but AI starting to disrupt the labour market. IBM CEO saying he expects 30% of its back office jobs to be replaced by artificial intelligence in the next 5 years. Want to bring Ed back into the conversation. Ed, that is a big number, isn't it?
It is a potentially big number. So IBM CEO Arvind Krishna joined us in New York yesterday across some Bloomberg reporters and editors. And you're right that it's focused on the back office. So IBM has 260,000 staff globally. Around 26,000 of those are back office. So at 30%, you're looking at around 7,800 jobs. In the first instance, what Krishna was talking about was pausing hiring in areas where it looks like those roles in the future will be displaced by AI. What an IBM spokesperson later clarified after that conversation was that could also be just through attrition, right, as part of any reduction rather than sort of active layoffs. Also interesting to get the economic outlook from somebody from like Arvind Krishna, right? And he basically is somebody that did not see a recession in 2023. He told us yesterday in that conversation, Jonathan, he now sees a shallow and short recession by year end.
Him and everyone else seemingly sees the same thing. Ed, thank you. A very consensus view there. If you missed the promo a little bit earlier, look out for Ed Ludlow sitting down in conversation with Dara Khosrowshahi, the Uber CEO, together with Emily Chang a little bit later this morning, about 2 hours or so away on Bloomberg TV. In the broader equity market, about 23 minutes into this, we're negative 0.4% on the S&P with a sector price action. Back with us, here's Katie.
More losers than winners on a day like today. Let's look at some of the winners. You do have healthcare in the green, as to is discretionary, as to is that tech sector, but still really small gains, small losses too, except if you look at energy way down there at the bottom, off by 2.7%. Then you have materials and financials on the back foot as well. And let's quickly go to some education stocks, because on the back foot as well, after we heard that AI warning from Chegg, really having some ripple effects here.
Katie, thanks for that. Coming up, your trading diary up next. call it 26 minutes into the session. We're negative here by 0.5% on the S&P, down just a touch on the Nasdaq, negative by 0.1. Real underperformance in the small caps, the Russell, negative more than 1 full percentage point. That's the price action. Here's the trading diary. What a week. Factory orders, durable goods at the top of the hour. The main event tomorrow, Fed decision, Chairman Powell news conference. Then it's the ECB's turn on Thursday. After the bell on Thursday, Apple results. And finally, rounding out the week with the US payrolls report. The median estimate in our survey so far, 180,000. From New York, that does it for me. This was the countdown to the open. This is Bloomberg.